I'm going to start with a little story from 1999, probably one of the most influential discussions I had as an investor. But to set the stage, we were a fairly young firm, just in business for a couple of years, and we hit the internet bubble. And for those of you who know what value investing is, you know that that's not a good place to be when everybody's investing in internet stocks. And we had a period of massively underperforming the markets. And into my office came a woman, a client, who sat down and looked me straight in the eye and started the meeting by saying, "My grandmother is a better investor than you are. All you have to do is buy Cisco. Everybody in the world has figured this out except for you, and you're just stubborn." And I was never fazed by that kind of interchange, so I engaged with her and said, you know, Cisco has a market value of $500 billion. At the time, it was the most highly valued company in the market, in the world, really. And you're used to making 15% a year. It's what you've been making for the last 5 years. So if I was going to buy this whole company and write a check for $500 billion to make 15% a year, the company would have had to earn $75 billion per year. They were earning $1 billion. So I said, don't you think there's something wrong with this arithmetic? And she just looked at me and said, you don't get it, do you? To which I had to agree, I didn't get it. So now I find myself in the same place as I was back then. I really don't get the arithmetic. It's really, investing is supposed to be just arithmetic. Then it was Cisco, today it's Tesla. Tesla just became a $1 trillion company. To make 15% a year, if I own the whole company, Tesla would have to earn $150 billion a year. The entire auto industry in the world earns $75 billion a year. So I'm thinking there's something wrong with that arithmetic too. So today, what I'm hoping to talk about is trying to understand the arithmetic. What assumptions do you have to make for the $1 trillion of Tesla to actually make sense? So it's working backwards from the price that you have to pay to come up with the assumptions you need to make for the investment to make some economic sense at all. So let me set the stage. It's now been 15 years since growth has beaten value. Everybody has seen a chart like this. This is not anything that's a surprise to anybody, but after those 15 years, that gap of 6% a year adds up to a huge difference. If I had simply bought the growth index instead of the value index, I would have twice as much money as I had then. This is another one that I find to be a compelling chart. This chart compares the valuation of the cheapest stocks with the most expensive stocks. So what you can see here is the blue line that runs horizontally across the bottom is the price to earnings multiple that you had to pay for cheap stocks. So what do I see when I look at that chart? I see that basically for the last 60 years, you can buy stocks at roughly the same valuation. The orange line is what you have to pay for the most expensive stocks. Here, really for the first kind of 20 years of this chart, you could buy expensive stocks for 2 to 3 times the price of cheap stocks. Today, you have to pay 6 or 7 times the price of cheap stocks. The divergence started around 1980. That's right when interest rates reached their all-time highs and went on a 40-year decline to effectively their all-time lows. And the value, the multiple of earnings that people paid for the most expensive stocks got higher and higher and higher and higher. And that was what has been mostly responsible for the outperformance of growth stocks. It's for the Teslas of the world to have gotten to the kinds of valuations they've had. The valuation headwind has been enormous. This chart really brings this whole point home. This is a chart of the market value of stocks that trade for more than 10 times sales. 10 times sales is a big number. And you can see that nearly $14 trillion of market cap, that's about 30% of all stocks measured by their market value, trade for more than 10 times sales. To make a good return, buying something at 10 times sales requires extraordinary performance by the companies that you're paying these high prices for. If you were going to look backwards and over this period of time, see how you did if you bought stocks that were trading for more than 10 times sales, the results would have actually been negative. And over the same period of time, that the stock market was up by 10% a year or more. It really leads you to think, what is it that I have to believe to justify these kinds of valuations? The rest of the presentation is going to be focused around analyzing companies to try and understand, what do I have to believe to get to a reasonable return? Now, we defined reasonable here as an 8% total return, or internal rate of return, as the financial lingo would call it. We picked 8, not as an arbitrary number, but that's what the stock market has returned over the last 50 years. So what I'm going to do is go through a group of companies and back into the macro forecasts, or the company-specific forecasts that you have to believe to get an 8% return. And I'm going to compare growth to value. Now, the growth stocks here, and you can see what I've chosen, Tesla, Microsoft, and PayPal, they all trade for 10 times sales or higher. The value stocks, Volkswagen, GE, and Halliburton, are not the companies that everybody is excited about, but nevertheless, we can calculate what do you need to believe for those companies. Here's the data on these companies. The 3 growth stocks, they're all spectacular franchises. They're all doing wonderfully well, and they trade at eye-popping valuations. Tesla is at 18 times sales, 140 times earnings. Microsoft's at 12 times sales, 34 times earnings. PayPal is at 10 times sales, 40 times earnings. Now, the 3 value stocks, actually, they all have great franchises too, but they're facing some sort of difficult current environment or transition in their business. They all have substantial market skepticism about their futures. But it'd be hard not to say they weren't great franchises. Volkswagen sells for 0.4 times sales. GE, 1.5 times sales. Halliburton, 1.4 times sales. On a price to earnings basis, 6 times for Volkswagen, 26 for GE, 15 times for Halliburton. What I'm going to try to demonstrate today is that you need extremely optimistic assumptions to get to an 8 IRR, to invest in the growth stocks. And if I make extremely pessimistic assumptions about the futures of the value stocks, I can still get to an 8% IRR. The market is very crazy, very skewed. So let's start with Tesla. What I want to do is just together do an analysis of what do you have to believe to get an 8 IRR. Now, Tesla has achieved some amazing things since its founding 18 years ago. But those amazing things today amount to getting to be about 1% of the world's auto market. You have to assume that Tesla gets to a 13%, and by the way, I'm going to make optimistic assumptions, and I still won't be able to get an 8 IRR for Tesla, but I'm just going to lay out what those optimistic assumptions are. I have to assume that Tesla's volume goes from up to 13.7 million units. That's a 13% market share 10 years from now. That would make Tesla the biggest auto company in the world. If electric vehicles at 10 years from now represent 50% of total sales, then Tesla would have to have a 25% share of all electric vehicles sold. 50% is the most optimistic forecast out there. That's a forecast that is consistent with maximum government intervention to subsidize electric vehicles, to set up charging stations all over the world, and to penalize and be punitive for businesses that burn carbon and emit emissions. The lower end of that range is around a 20% share. So if I was going to look at all the experts, you would say something between 20% market share and 50% share. If Tesla were selling for the 13.7 million units that Tesla would be selling, if electric vehicles were only 20% of the market, it implies that Tesla would have to sell 2/3 of every electric vehicle being sold. Is that possible? Maybe. Is it fanciful? I think so. Tesla's an amazing brand, but there are other iconic brands out there that are also trying to compete in this world. The other thing that I would have to believe here is that Tesla would be able to sell its cars at 2 times the average world price for a car. Now they're doing that right now. They're selling cars for $50,000 a car on average, where the global market average for a car is $25,000. It's quite possible for them to do that when they have a 1% market share, because that's who they're selling to. They're selling to the 1%ers who can afford to spend $50,000 on a car. Can they get to 13.7 million units, a mass market, and still maintain $50,000 a vehicle? That seems like a highly optimistic view. Even with these assumptions, that they keep their price at $50,000 a vehicle, they get to somewhere between 25% and 2/3 of the market for electric vehicles, Tesla would earn in that environment about $55 a share. They would be the highest margin auto company ever, and they'd earn $60 billion, $55 a share, and you paid $1 trillion for this company. Now, I didn't do the exact arithmetic. I'm asking you to trust me on that. They're very rough assumptions, but these are eye-popping margins that have never been achieved by a car company and still don't even get you close to an 8% IRR. So clearly the market thinks that Tesla is more than a car company. To try and justify the $1 trillion valuation, you need something more than dominance in selling cars. You need to believe something like Tesla is going to become a dominant force in autonomous driving. It's the largest market potential of the things that Tesla is working on. These are the assumptions that you would have to make to get us to the 8 IRR. You'd have to believe that the size of the autonomous driving market is something like $2 trillion. That's about 4% of global GDP. You would have to double the amount we spent on cars today to get another $2 trillion of revenue to the auto industry. On top of that, you'd have to assume that within 30 years, 50% of all cars would be equipped as autonomous driving. Given how long it takes to turn over the fleet, that's clearly an optimistic assumption. I would say nearly impossible, but not impossible. You then have to assume that Tesla wins this market, and that here we've made the assumption that they have a 25% share of all autonomous driving. And finally, that they would make as much profit as the most profitable company in the world, like Microsoft, a 35% after-tax margin. Is this possible? Sure, it's possible. Could it even be better than this? I suppose. Would you bet on it if it turned out to be true and you made an 8% IRR? Not me. Let's compare this to Volkswagen. What do you need in Volkswagen? What assumptions do I need to make in Volkswagen to get an 8% IRR? Volkswagen today sells for 6 times earnings, 8 times its current free cash flow. For Volkswagen's earnings to drop in half, you'd have to make some assumptions that sound like this. The earnings on their traditional internal combustion engine vehicles go to 0. Now, that's in spite of, and by the way, this is over the next decade that we're talking about. That's in spite of a strategy that seeks to minimize investment in new technology, new internal combustion engine technology. You'd also have to assume that Volkswagen's price points for electric vehicles decline precipitously. Today, their $50,000 average price point is comparable to Tesla's. And Volkswagen's achieving this through its iconic brands of Porsche and Audi, where they can sell electric cars for substantially more than $50,000 and average a $50,000 price. But we'd have to assume that price drops from $50,000 to $35,000. We didn't make those assumptions for Tesla. We'd also have to assume that their share of the electric vehicle market declines from current levels, even though other than Tesla, this is the company that's leading the pack of the traditional automakers. And when they do that, they would earn half the margin that they now earn on internal combustion engines. Could all those things happen? Sure. Does that feel pessimistic? Yes, feels pretty pessimistic to me. But if that happens, you earn an 8 IRR. Could it be better than that? I think there's a high probability that it could be better than that. There's people today who think the Porsche brand alone is worth more than the entire Volkswagen. So clearly, there's 2 separate kinds of markets here. There's a market of people who invest in Tesla who have wildly fanciful views of what this company can achieve, possible, but wildly fanciful, and the different kind of people who invest in Volkswagen, who are amongst the most pessimistic people in the world at believing this company that's been around for decades is suddenly going to falter and be unable to compete on the same basis that it's competed in the past and still get an 8 IRR. Clearly, there's some skewing going on. Volkswagen is priced with a skewing in your favor. Tesla is priced with a skewing against you. What do I mean by that? If the best outcome happens, you make 8. If something worse happens, you make less than 8. In Volkswagen's case, if the worst outcome happens, you make 8. If something better happens, you make more than 8. Seems pretty much like a no-brainer to me. Let's try another set of companies. Let's look at Microsoft. Microsoft is a stock that's owned in almost every major institutional portfolio out there. But with the stock at 35 times earnings, you have to assume that earnings triple over the next 10 years to get an 8 IRR, if at the end of that 10 years, Microsoft's earnings growth rate returned to that of just the average company. Now, how likely is that? What assumptions do I have to believe for Microsoft's earnings to triple over the next decade? Well, Microsoft is a company with $185 billion in revenues. About 20% of that comes from Azure, which is its cloud business. This is infrastructure, software, and platform as a service. This is a great business. It's growing very nicely. and everybody sees the wonderful benefits of this. The remainder of Microsoft, the other 80%, is Windows, Office, and a few other businesses. The non-cloud businesses are growing mid to high single digits. So for earnings to triple with 80% of the business growing mid to high single digits implies that Azure has to grow 22% a year for the next 10 years. Of course, that's happening right now. Can it continue to happen for the next 10 years? Well, this chart compares the size of the cloud market with the size of the total IT market. On the left-hand chart, as you can see, the IT market today is $3.1 trillion. In 10 years, it should be about $5 trillion. Today, cloud's about $330 million. After 10 years of 22% annual growth, it would be $2.4 trillion. So that would be roughly half of all IT spending. So if Azure maintained its market share, all private cloud would have to capture half of all IT spend today. Now, remember, today, the public cloud is primarily infrastructure. It's moving our servers out of our premises and into the cloud to more efficiently utilize them and service them. It's a brilliant, brilliant strategy. Most experts believe that number could double to about 70% that could ultimately be in the cloud. Not every server can be in the cloud because of the sensitive nature of certain data will never be put into the cloud. That would get you to $660 million of cloud revenue if it doubled. But it still has to quadruple from there to get to the $2.4 trillion. So the implications are that the cloud would have to capture more than infrastructure. It would have to capture platforms like Windows or software like Salesforce. They would have to capture that revenue in order to get to this kind of volume. Now, so it's not just infrastructure. Now, is that possible? Sure, it is. Is it likely? It's hard to believe, especially if you believe that the margin stays sustained at the 70% level that they currently earn. So if I was going to analyze the Microsoft's Azure business from a gross profit perspective, you can see what that implies on the chart on the right. Today, the entire gross profit of the IT industry is about $1.5 trillion. If industry margins remained flat, that number would be $2.4 trillion in 10 years. If public cloud producers grew at the 22% a year that was implied to get Microsoft IRR to 8% and maintain their 70% margin, the gross profit would have to be $1.7 trillion. That's 70% of the industry's gross profit. So you have to believe that the cloud players capture 70% of the industry gross profit in the next 10 years in order to and Microsoft maintains its share in order to justify or to achieve an 8% IRR. Now, to do this, what does that imply? They have to capture revenues that other people believe are proprietary to them. Take Salesforce.com. How is it that Microsoft is going to be able to host Salesforce on its cloud and capture a 70% margin marking up someone else's proprietary software? Sounds pretty crazy to me. You'd also have to capture services businesses, which are the laborers of people where we mark up their labor, the programmers. that have typically earned margins substantially less, something like 10%. So I can't figure this one out. I don't see how the arithmetic works. And it doesn't even consider the idea that at some point when the growth rates start to slow, price competition might emerge. We just are accepting that a 70% margin for hosting servers in the cloud is something that they're entitled to indefinitely. When the growth slows, I think it's inevitable that price competition will emerge. It's like saying they won't try to go after each other's customers. And I don't think there's any precedent for that in more mature businesses. So clearly, Microsoft investors have rosy expectations. Let's take the opposite, GE. Like Volkswagen, GE's been around for 100 years. It's well established as the dominant player in jet engines with greater than a 50% share. It's the dominant manufacturer of gas turbines for generating electricity, 40% share. It's a dominant player in medical equipment, 33% market share. And despite a deviation from those core businesses over the past decades, the business has been rationalized and simplified back to its basic cores. So let's just focus on jet engines for a minute because it's their biggest business and should account for half or more of their normal profits. You make money selling on a jet engine, not when you sell it. The profits are not tied to the sale of new jet engines. They're tied to keeping the existing jet engines running. The margins are extremely low on a new sale. So the biggest variable that impacts GE is air travel. So take a look at this slide. This is a history of air travel. The solid line is the most commonly used metric of air travel, revenue passenger miles, indexed back to 1990. And the dashed line is global GDP. So what do you see? Well, for the last 30 years, and the data actually goes even further back than that, air travel has grown faster than GDP, much faster than GDP. Why? Well, when people get richer and have more income, they travel more. The line extending to the right is our forecast. Obviously, GDP just keeps growing at global GDP, nothing controversial in that. But today, air travel is about 60% below pre-pandemic levels. If I make the assumption that from this point on, we just grow with GDP, it would actually take you 20 years to get back to pre-pandemic levels. If I make that assumption and GE sizes its aviation business for that size market, you would get an 8% IRR on GE without a recovery to pre-pandemic levels. Now, we made some other, what I think of as pessimistic assumptions to get to that 8 IRR. The margin is 200 basis points below history for aviation. The margin in medical devices, in spite of there being nothing wrong in that business, is 200 basis points below history. The margin in their power systems business is half of their history, and there's a steady decline in power generated from natural gas. And lastly, we need to make a capital injection into GE Capital to fix all its ills of $5 billion. And when I make all those assumptions, I get an 8 IRR on GE. Could they be right? Of course, again, of course. Is that likely? I doubt it. So basically what we're saying is that if GE produces about as bad of an outcome as you can imagine, you'll get an 8 IRR. Given the history of these franchises, it's unlikely that it's going to be that bad. The management is dedicated to improvement. They're actually, if you actually listen to the management's optimistic forecasts that include a recovery in air travel, a success in managing margins, that there is some demand for natural gas fire, that we need more natural gas generating electricity. And actually most people believe this still, because we still have so much coal that we have to replace in the world. And we put a 0 value on GE Capital instead of a negative value, you can get to IRRs that are more than double the 8. Again, things are massively skewed, Microsoft versus GE. Let me just do one more set of assumptions before of companies before I completely bore you to tears. PayPal. PayPal is a highly powerful e-commerce payments platform. They've done an amazing job of exploiting people's fears of exposing their credit card on the internet. And they've also added massive convenience to have a digital wallet, so you don't have to constantly re-enter a credit card when you go from website to website. But hard to argue that that isn't a smart and great thing. And they've turned it into a great business model, earning credit card processing fees on every transaction that is processed through PayPal, even though many of the transactions are not cleared by a credit card. People enter their debit cards into PayPal and they enter their bank account numbers directly, which avoids the credit card processing fee. Yet when PayPal processes a payment for an e-commerce retailer, they charge full price as if it's a credit card. So they make a huge spread. This is a brilliant, brilliant business model. It's clearly costly to retailers. They don't like it. But they've concluded they got no choice. If they want to make sales, they got to put PayPal on their site. So what do I have to believe about this great business to make an 8 IRR? Well, essentially, it's not believable. PayPal's share of e-commerce is about 15%. That's up about 1% in the last 5 years. I have to assume it doubles to 30% over the next 10 to get an 8 IRR on PayPal. And that's without really access to the Chinese market, which PayPal doesn't have access to and is a giant e-commerce market. If we excluded China from the arithmetic, PayPal would have to get to a 60% share of Western retail sales, e-commerce sales. Is this possible? Sure. Likely? I don't think so. Amazon doesn't accept PayPal. eBay is weaning itself off of PayPal. Why? Because it's really costly, because it converts a debit card customer to a credit card fee. Anyone who can try and free themselves will. But not only do I have to make those assumptions that nobody else will, I have to assume that that the erosion in pricing that PayPal has experienced will slow compared to its history, and that the margins they earn on this business will have to be higher than the management targets. Clearly, like in Tesla's case, the market sees something in PayPal besides e-commerce, because I can't get an 8 IRR from the e-commerce market. I think PayPal understands the arithmetic doesn't work. That's probably why they're on an acquisition spree, including the recently rumored interest in Pinterest. Paying a valuation higher than your own is a very tough way to make it work for your shareholders. Maybe one of their other ventures will hit. It's possible. Should you bet on it if the net outcome of that is to get an 8 IRR? I wouldn't. Nevertheless, hope springs eternal. Let's compare it to Halliburton on the other side. Halliburton is a dominant number two player in oil field services. Clearly, the market is transitioning away from carbon-based energy sources. Halliburton makes money when you develop an oil and gas, when you drill, when you develop oil and gas fields. So obviously the transition from oil and gas to something alternative is key to whether you can make a good return on Halliburton stock. So shown here is the historical demand and forecast for oil and gas. It's historical demand along with two forecasts, I should say. The bars show a forecast that we've called sustainable development. This is consistent with a 2-degree maximum global temperature rise done in a way that can be affordable to society. So it takes a long time to get to a transition. The orange line superimposed over this shows an aggressive transaction. But that's actually the forecast you need to make for Halliburton to earn an 8 IRR, meaning if the transition is slower than that, you'll earn more than an 8 IRR on Halliburton. The IEA, the International Energy Agency, recently published a forecast like this. It wasn't actually a forecast. It was actually, what do I have to do to aggressively reduce carbon emissions in the world? Unfortunately, this is deemed impossible by most economists because you'd have to devote most of the world's resources to climate change. You'd have to have major subsidies for electric vehicles. You'd have to have substantial taxes on carbon emissions. And it implies that the world would have to accept a decrease in its standard of living as it diverted resources away from things that added to the standard of living to things that solved the global environmental crisis. Should it happen? Of course. Could it happen? Yes. Will it happen? Seems very long shot to me. If it did happen and I invested in Halliburton, I would get an 8 IRR. Interestingly, in both cases, both the aggressive transition case and the sustainable development case, Halliburton's earnings are almost certain to rise over the next few years, simply because we're drilling so few oil wells today, we don't even have enough oil to make the aggressive transition case. It also assumes that Halliburton will be completely unsuccessful in all of its new investments, future endeavors to create a new business that's not tied to carbon. This sounds very different. The idea that Halliburton will fail in all of its endeavors with certainty, and PayPal and Tesla will succeed in its endeavors with certainty, as massive, massive skewing. All, though, are working on promising technologies. So I think I've beaten a dead horse. My conclusion to all of this is the world is a strange, strange place. The companies that we favor have high valuations that require very optimistic assumptions, and there's substantial risk that it won't come out as good as everybody expects. The out of favor stocks have more normal valuations but they're based on this belief that nothing good will happen. To me, this seems like an incredible opportunity for making money in the markets. I hope I've provided some provocative food for thought, and I appreciate your inviting me to speak.